Hello, everyone. So while everybody joins in, in the interest of time, we will begin this webinar. My name is Kamal Manocha. Welcome everyone to this Friday webinar. I represent PMS AIF World. Over last 3.5, 4 years, we have been, running our journey with the full discipline of doing webinar every Friday to learn from new fund managers about various strategies. And all of us have primarily focused on equity as an asset class, because equity as an asset class is considered to be one of the best asset classes to generate and create wealth. And all of us are here to learn with the ultimate goal of creating wealth. But obviously, equity as an asset class has an element of risk, and that is where, to kind of attempt to manage or invest into equities in asset class requires a skill. And skill set we have seen, kind of represents that one needs to understand various sectors before investing. One needs to understand kind of, how to do sector rotation over a period of time. We have also understood how to identify stocks, businesses, how to kind of see businesses as value business, or maybe a growth business, or maybe a special situations. All these are various styles of actually investing into equity in a kind of a skillful manner. Also, while we are attempting to do equity investment, we have also learned that time in the market is more important than timing the market, because all the long only equity focused skilled fund managers have kind of pressed always on the fact that risks are short term but growth is long term, so one should focus on long term. Thirdly, we have also learned that macro as a kind of a matter of risks is only an entertainment. One should not too much focus on macros. However, in today's webinar, we're trying to kind of learn totally diagonally different strategy. This is another way of creating wealth, maybe a more smart way of creating wealth, and that is why we have named this webinar as Smarter Way to Creating Wealth. Worldwide, we have seen over the last 5 years, macro factors have actually played a lot. So we cannot shun macro factors by saying, if we follow data, we cannot kind of say that macro is just for entertainment. Macro is kind of, putting a lot of volatilities and obviously throwing a lot of hence opportunities also for fund managers who approach investing not just as a skill, but as a science. And that is exactly, what is the topic and what is the idea behind today's webinar. And I have taken this first minute to kind of give you this, hence the context. The guest that we have today who will kind of be speaker for this webinar is Mr. Siddharth Vora, who is the fund manager from Prabhudas Lilladher group. He has over last 1 year created, conceptualized, kind of deep dived, and then launched another, very, very interesting PMS from Prabhudas Lilladher, where they are trying to approach investments more as a science rather than a skill. It's a very unique, very differentiated portfolio management service. We have seen more than 250 portfolio management services that we study. This is a very, very rare strategy where science is applied as an approach to actually create alpha as well as create returns which are superior in terms of risk adjusted returns. Siddharth brings with him a very, very credible background in terms of his academics. He's a chartered accountant, he's CFA, as well as he has gained certain certifications from Harvard Business School as well as from London Business School. So, without taking much time, I would hand over to Siddharth for him to kind of show us with data how multi-asset dynamic portfolio approach, which is more like a science than skill, is kind of trying to disrupt and trying to change the investor kind of experience in terms of creating wealth. Over to you, Siddharth.
Thank you. Thank you so much. And kind welcome to all the people who've taken out time on a Friday evening to join us for this presentation today. So today I'm going to talk about how asset allocation, more specifically dynamic asset allocation, can not only help you create wealth across cycles, but also protect your downside in bad cycles. And as we've all experienced over the last how many ever decades, and maybe more recently right now, that markets, while they give you and reward you over a very long period of time, they also make that journey very bumpy. And it's the volatility that investors find hard to deal with in the short to medium term. So while all the theory around investing for the long term is true, relevant today as much as it was maybe a decade ago. But the reality is that the long term is a journey of multiple short and medium term periods, and our endeavor is not only to make the long term picture look good, but also to make sure that the short term journeys along the way are not too bumpy. And that's the basic context of this strategy, and that's how I'm going to take you all through. So firstly, before I go into the strategy, a little bit about the PL group. So we, as you all must be knowing, hopefully, that we've been in business since 1944, and we're almost approaching our 80th year of business. And our impression and personality as a firm has always been to rely on integrity and ethics as the driving pillars of business. But given integrity and ethics, what do we derive all the business from? It's mainly our focus on research. So we operate across institutional equities, investment banking, investment management, advisory, wealth, and broking. But the main driving force for our business is our research-oriented approach. We track more than 250 plus stocks in the large cap, mid cap, and small cap universe. We have a 45 member plus research team. And given all of that, we obviously have strong access to corporates and management across India. And our PMS across strategies, whether equity or asset allocation, the basis of managing money has to be framework driven, science driven, process driven, rather than pure judgment or skill driven. Of course, that comes in as well, but we've tried to make the process as detailed, scientific, and simple as possible. So with that, I'm going to now go into the bigger topic for the day, which is about asset allocation, and more specifically, dynamic asset allocation. So I think two things that everybody might have heard in their investing journey so far are the concepts of strategic allocation and tactical asset allocation. Strategic asset allocation more simply means that you make your investment decisions in line with your risk profile and your investment objectives. Your risk profile would include things like your age, your liquidity requirement, your risk appetite, your tolerance for risk, your willingness to take risk. And that is why it is known as strategic asset allocation, because it is more static in nature. It is tailor-made to every individual. Tactical, on the other hand, is the complete opposite paradigm of strategic asset allocation. Tactical really refers to making investment decisions based on risk management as an asset class level, rather than risk management at an individual level. And there's a big difference between the two. So if my outlook for equities based on our quantitative models is very positive, then ideally I have to go overweight on equities to a big extent. And that is tactical. But if my strategic guidance for a particular individual investor says that he is a conservative investor, so irrespective of, even if I think 70% should be my allocation to equities, I will not cross 40% threshold in that particular investor, because that is his strategic investment objective. And therefore, these two differ in a big way. What we do for our strategy, which is known as multi-asset dynamic portfolio, we take strategic asset allocation, we take tactical asset allocation, and we combine the two of them into a portfolio construct, and we call it dynamic asset allocation, which means some part of your portfolio will be tactically managed, some part of your portfolio will be strategically managed. And therefore, we need to understand that this involves an element of active rebalancing. It is outcome oriented in terms of managing drawdowns, generating returns, managing risk-adjusted returns, and controlling volatility. At the same time, it is opportunistic in nature. When we believe equities are tremendously undervalued, we are open to take our equity exposures up to 80%. And when we believe, say, equities are highly overvalued, the momentum is fading, the macros are turning adverse, we are open to take our equity allocations all the way down to 30% as well, which means this is a dynamic style of managing money. And the advantage of a style like this is, by mandate, I'm not forced to stay long only equity, even if the market outlook for 2 years is bad or a sector outlook has turned extremely adverse. The advantage is that in a rising market, we participate with the market to a very great extent. And in a falling market, we are able to control drawdowns to a huge extent. And that is why we believe this strategy is relevant on both sides of the market cycles. And by experience of a long-term, medium-term, and short-term, I think everybody would agree that you have to face both sides of the coin, and it's not just managing returns or generating alpha. It's also controlling drawdowns that lead to alpha over a long term. A little bit on global trends of how things are shaping up in India and around the world. So we've seen a massive, shift from active managed funds to passively managed funds in US and the Western economies. I think India is also following suit now. And what we see here is that in 1998, only 11% of assets were passively managed, 89% were actively managed. Jumped to 2019, this ratio is 50-50. And as per early trends, as of 2022, this number is north of 69%, which means passively managed index funds and ETFs are now controlling 69% of the total financial AUM in markets. And everybody must understand why this is happening. And so it's basically two things. It's the returns that make investors feel that, okay, post investing in an actively managed fund for a very long time, I'm not able to either generate significant alpha or not able to justify the costs. So when this happens cycle on cycle, people tend to move towards passively managed instruments. The other thing is also that data suggests that AUM is now getting polarized towards ETFs simply because it's the most easy and no-brain solution to getting exposures to equity markets. Now, when we look at Indian data as well, we see that passive managed funds and quant managed funds are rising. And over the last 7 years, I've actually populated one slide that shows you in US how has the active, passive, and quant AUM evolved. And this one slide pretty much tells you that over a longish period, which is 7 years, quant AUM has grown at 18% CAGR. Passive funds have grown at an 11.5% CAGR, and active managed funds have grown at a 1.8% CAGR. If you go and shorten the period a little bit more, we see that active is actually losing. So it's actually losing market share to passive and quant funds, which are still, generating 10 to 13% sort of growth in AUM, whereas actively managed assets are compounded losing AUM. And this is an important thing to keep in mind because it's relevant to the strategy I'm going to talk about today. So the active versus passive debate and who wins, I'm going to quickly take a minute here. So basically what we're trying to show with data is that over a 1 year, 3 year, and 5 year period in the Indian equity large cap space, 86% of actively managed mutual funds are not able to outperform the benchmark itself. So if I had two options, invest in the Nifty 100 index fund or Nifty 100 ETF versus an actively managed large cap funds, data suggests that 86% of the actively managed mutual funds are not able to outperform the passive benchmark itself. And this again is relevant as I build along the different contours of the strategy. Why passive is so important, I will come to that. And this is just a small snapshot on how globally and in India, quant is rising. And the rise of quant has also got to do a lot with the rise of the talent, the data, and the technology around quantitative investing. 30 years ago, we didn't have the right talent. We didn't have the right technology platforms. We didn't have the right sources of clean data. As of now, all of that is available. And as data, talent, and technology grow exponentially from here, we believe quant is only going to take over active management more and more. And now coming to the big concept of today, we're talking about power of asset allocation. Why is asset allocation so important? So I've populated data from August 2006 till March 2022, which is a very, very long enough cycle to see which strategies have really performed well, which asset classes have really performed well on a risk-adjusted basis. So the first three strategies that we talk about are your strategic asset allocation strategies, whereby you decide a mix of assets say 50% equity, 30% debt, 20% gold, and you stick to that particular strategy for time immemorial. Similarly, a moderate strategy would probably mean a 60% equity, 20% debt, 20% gold, and an aggressive one would probably mean 70% equity, 30% in non-equity. So the first three bars are representing the strategic asset allocation strategies. The fourth bar represents the dynamic asset allocation strategy, and all the other bars that you see represent all the mono or single asset classes such as large cap equity, mid cap equity, Next 50, Nasdaq, S&P, gold, gilt funds, and corporate bonds. So it pretty much covers the broad spectrum of asset classes. What is important to notice here is that your blue bar that signifies returns and your yellow bar that signifies risk and the black dot signifies Sharpe ratio, which is nothing but risk adjusted returns. So as an investor, your final endeavor is to have the highest Sharpe ratio, to have the lowest yellow bar and a higher blue bar relative to the yellow bar. So now when we look at the first four bars, which are asset allocation bars, we see that the dynamic asset allocation strategy outperforms all the strategic asset allocation strategies on a risk-adjusted basis, not only in terms of returns, also in terms of lower risk and a much higher Sharpe ratio, therefore. When we look at all the single asset classes, such as large cap, mid cap, etc., we see that the returns could be superior in some cases, such as Nasdaq maybe, but on a risk-adjusted basis, they are extremely inferior compared to a dynamic asset allocation construct. And this is very important to understand why an asset allocation strategy helps you in good times, but helps you even more in bad times. So how do we do this? Let's get to how do we do this strategy. So we have three important principles here. First is that our fact and science suggests that 91% of investment returns are generated by the asset allocation decision alone. Only 9% is generated by stock selection, market timing, etc. So we have decided to focus only on this 91% pie, which is smart asset allocation. Secondly, we've decided to have an extremely disciplined, data-driven, process-oriented approach. And therefore, we don't say that your money is left to any sort of emotions, judgment, experience, all sorts of things that are not repeatable in nature. We don't want to associate with them in this particular strategy, which means I might have got one particular cycle really right in terms of understanding, but who says that I can get the next one right? So we're not going to rely on judgment and experience. We are going to rely on data and science. And the last one is that we stick to only blue chip instruments, which if left in your account for eternity would never make sure that you would never lose capital, which means we take exposure through index funds, ETFs of the bluest of the blue chip instruments, not stocks. So we don't invest in stocks, we don't invest in sectors, we don't invest in style factors. We simply invest in asset classes. And we use our proprietary quant meters to make these decisions. We eliminate all sorts of stock selection, style selection, and fund manager risks in this strategy. And the asset classes we can take exposure to in this strategy include domestic equity, debt. Debt spells across corporate bonds, gilt funds, and liquid funds. Commodities across gold and silver, alternates across REITs and InvITs, and international across US equities and other international equities. All these exposures are taken via AAA securities such as index funds and ETFs alone. We do not invest in actively managed funds or direct equity for that matter. Now, a couple of other points about the strategy that we showed you the asset classes we invest in. We follow a tactical dynamic asset allocation approach. We are 100% rules-based. We use quantitative, fundamental, alternative, and technical data to make these decisions. We follow a trigger-based rebalance system rather than a time-based rebalance system, which means our models are allowed to rebalance at any given point in time, not necessarily once in a year, once in a quarter, once in 6 months, because when things change, it never tells you that, okay, I will change at a quarterly schedule or a half yearly schedule. So we have to be alert and agile all the time. And our triggers and models tell us when we should make this rebalance. And what we try to achieve for our investors is superior downside protection, strong upside participation, and consistent performance, because we are rules and system based. And that forms the genesis of our strategy. Now coming to the main part of the strategy of why we are so differentiated, why can we do this maybe better than the others out there, or maybe better than an individual investor sitting at home, is because we have invested 4 years in building the architecture and technology to make sure that the asset allocation decisions come absolutely in an unbiased format, are 100% controlled by forward-looking and backward-looking data alone, and our human emotions are not overriding these decisions. So designing this architecture has taken a specialized team of 16 people, chartered accountants, economists, statisticians, mathematicians, Python programmers, etc., who've put 3.5-4 years in building this. And now that we have this proprietary methodology and framework ready, we are managing public money using this. So what are the pillars and what are the key decision-making factors that help us do the asset allocation on a dynamic basis? So like in equities, the way Kamal mentioned, we look at multiple things, right? Such as valuations, growth, the management quality, the ROE, capital efficiency of a business, maybe the leverage of a business. There are multiple things we look at. When we're doing asset allocation, also, I would like to admit that there is a science to it. It is not random. It is not arbitrary. Neither is it only driven by economic cycles. It has multiple layers to it. And the big part of time has gone in first identifying what these layers are. So let me start straight away. Our key endeavor here is to identify inflection points in asset class cycles. If our model enables us to identify these inflection points, a big part of our work is done. So to identify inflection points, we need to understand what really contributes to a performance of a certain asset. So what we have arrived at, that the first thing that is relevant from a long-term basis is the economy itself. So we have built a proprietary tool called the Macrometer, which uses close to 25 domestic and global economic indicators to tell us which part of the economic cycle we are in, and therefore what should the asset allocation implications be. But we know for a fact that macro alone is not enough, and therefore we add the second layer to the strategy. The second layer is the monetary cycle. So the first layer was the economic cycle, the second layer is the monetary cycle. The monetary cycle helps us understand global interest rate cycles, liquidity, and money supply regimes. And these have lasting implications on all asset classes, particularly on equities. And common sense also tells us that when liquidity and interest rates are falling, equities do well. And as we are in a rate tightening environment, equities are collapsing. So it's an extremely important variable from an asset allocation perspective. The third thing we use here is the cyclometer, or the tool that tracks equity market cycles. This is the third cycle that is relevant to us, whereby we gauge where we are in the market cycle based on valuation zones. After these three long cycle tools that we use, we also have short and medium term tools that help us navigate the smaller parts of the longer cycles. So one of them is the sentiment tool, which we have called the centimeter. We use 25 to 30 different daily leading indicators that help us gauge equity market sentiments across the world. We also have a tool known as Global Roro, which is also known as Global Risk On, Risk Off. The idea of the Global Roro is to avoid contagion effects in the markets. So when we look at global financial markets, our broad experience would tell us that when things go wrong at a global level, markets don't stop at a 5-10% correction. They can go all the way down to 50-60% as well, as we've seen in the history of markets. So the global RORO tracks 26 different developed market and emerging market indices across asset classes and commodities to check if the global financial world is moving its assets into risky assets or into risk-off assets. And if the whole world is moving towards risk-off assets and these trends have started emerging, means that a global contagion is possibly likely, and therefore we must be cautious in our asset allocation. Other than this, we also have a tool for technical analysis, which is not chart-based technical analysis, rather quant-based technical analysis. So that's the tool we call Technometer. In Technometer, we try to capture long cycle reversal and breakouts and technical risk reward across each of the asset classes, because they have significant impact in the medium term on asset allocation. The other tools we use are a multi-asset momentum meter, which is based on dual momentum across asset classes, which captures not just the absolute performance of assets, but also the relative performance of assets. We also use a tool known as relative value meter, which captures the attractiveness of small caps, mid caps, and large caps versus each other, and therefore navigates or guides us as to where should we be overweight even within equities. A multi-factor momentum meter, which captures the trend across the different factor style indices. For example, if value factor has started outperforming the growth and momentum factor, it is a clear indication that equity as an asset class could have a rough patch ahead. Similarly, if momentum factor is outperforming the quality factor, it's a clear indication that a bull market is about to come. And we also track two more tools like the inflation meter, which is extremely long cycle dated tools, and a volatility meter, which helps us decide where we are within different volatility regimes in equity markets. So with this whole architecture and toolbox that we have, we do 100% quant-based automated asset allocation. And the big effort that the team puts is in continuously monitoring, reviewing, and improving these models rather than using our brains to override these models. And the construct of the portfolio is as such: 50% of the portfolio is fixed in nature, which basically means it is a long-term portfolio and it will have long-term capital gains implications. Another 50% of the portfolio is tactical in nature. The tactical component is devised as per our meter readings. And the tactical component is further broken down into a core and a satellite, which indicates that 70% of your tactical is your core allocation, 30% of tactical is your satellite allocation. So basically, the easier way to view this is three baskets. First 50%, which is fixed in nature, which is more strategic and long-term. A 35%, which is your core allocation of the dynamic book. And a 15%, which is a satellite allocation of the dynamic book. So with this, we try to ensure that long-term returns, medium-term returns, and short-term returns and risks are managed via an allocation strategy of this sort. Now, I think the bigger aspects of the strategy are covered, Kamal, and I have more data on returns and how this can help in the short term. Maybe we can, start a Q&A around these facets. I'll take this one slide and then we can probably go to Q&A, right? So when we look at a returns and risk of a strategy like this, I've done two things. I've shown you a 3-year cycle data, rolling 3-year cycle data, and a rolling 5-year cycle data. And what is important to understand is, if we see in a best case scenario, worst case scenario, medium case scenario, and average scenario, how does a strategy perform? Then we get more conviction to weather the storm in good and bad times. So I'm going to take a 5-year CAGR story to start with. So the worst 5-year point-to-point return for multi-asset dynamic portfolio test has been a 7.6% return. But what is important to see here is, in this exact same 5-year period, Nifty 50 has given you a minus 0.7% 5-year CAGR. Small cap has given you a minus 7.4% 5-year CAGR. So even in a cycle like this, a dynamic asset allocation approach in the worst case scenario has been able to compound your wealth higher than inflation and higher than fixed deposit rates. Now, when we look at a best case scenario, let us see 23.6% CAGR over 5 years is the best case scenario, which is still a 5% alpha over the Nifty 50 index. It might be lower than small cap and mid cap because in a peak cycle or trough to peak, small caps and mid caps tend to give much superior returns, but not much superior risk adjusted returns. And a proof of that is that the standard deviation, a 5-year standard deviation of multi-asset dynamic portfolio is 8.8% versus a 5-year standard deviation of small cap index is 26%, almost 3.5 times that of a dynamic asset allocation approach. And the key takeaway here is that if an investor understands that I'm covered in a worst case scenario, he will be more than delighted in any other scenario, which is average, median, or best. Even if I look at a 3-year cycle, a 31.9% 3-year CAGR versus 26.4% for the Nifty or 30.5% for the S&P shows that this is in line or outperforming the broad indexes in good periods. Yes, we have underperformed NASDAQ, but everybody's seeing what's happening with NASDAQ. It's an extremely volatile index, and the standard deviation is again almost 2.5 times that of multi-asset dynamic. So I think this is broadly the return expectations and the risk expectations one should have with a strategy like this. And we can also see some of the short-term performances of different asset classes. This is data up till 30th June. So say on a 1-month basis, a multi-asset dynamic is down 2.6%. This is live data of the live fund that we're managing. Nifty is down 4.6%. Junior is down 6.4%. NASDAQ is down 10.8%. Even gold is down. So the idea is when all the asset classes are actually correcting, there's no way I can generate an absolute positive return. But what we can do is curtail your downside, which we have been doing. Even if you look at, say, 6-month data, you can see that we've not only been better off than Nifty, small cap, mid cap, NASDAQ, we've done fairly well on the downside protection as well. And even the 3-month data suggests that a 5.6% drawdown versus a much higher drawdown in a pure equity index. Now, the other point here is when the index corrects 10%, a concentrated portfolio of stocks selected out of that index usually falls much higher than that because of concentration and weighting. In a strategy that we are using, we actually invest in the index itself. So if Nifty 50 falls 10%, there is no way I'm going to fall more than that because A, I'm investing in Nifty, B, I'm not even fully allocated to Nifty. And therefore, the concept of capital arbitrage comes in. Capital arbitrage is the most relevant takeaway for this strategy. Assume 2 investors start investing at 100 rupees. One investor invests in a multi-asset strategy. One investor invests in an equity strategy. If the cycle turns, say, immediately after he makes his investment, his 100 might become 60, 70. A dynamic asset allocation strategy might curtail that 100 to say 92, 95 or 90. Now, after things stabilize, when the next upcycle starts, the investor with the asset allocation strategy has 92 rupees to start his count, but the investor with the equity strategy has to start his count at 70 rupees. And fortunately, if the dynamic asset allocation investor has only invested 40% in equity during the correction, he can take his equity exposure up to 80% on the rise back up, which means I have more protected fresh capital to invest in equities when my model tells me things are changing. I'm not going to make this decision. My model is going to make the decision for me. And this is the whole concept of capital arbitrage. And this alone is the secret for long-term wealth creation and long-term alpha generation for a multi-asset dynamic strategy. I've given you a similar snapshot of which sectors. I've also shown you that when 61% of Nifty 500 stocks fall more than 2 times the fall in MADP, which means that close to 300 stocks would have fallen at least twice that of MADP in the last 6 months. And what is the probability that you're not invested in these 300 stocks, right? And 30% of stocks have even fallen 4 times the fall in MADP in the last 6 months as well. And 35% of the stocks have fallen more than twice the index itself. So if the index is falling 15%, 35% of the stocks are falling 30%. And I think everybody has seen this in the last 6 months. And now the final long-term picture. So an investor who would have probably started in 2006 with a multi-asset dynamic portfolio at 100 rupee investment would have been at 1200 rupees at the end of Jan 2022. At the same time, Nifty would have compounded to 600 rupees and gold would have compounded to around 400 rupees. So the idea here is dynamic asset allocation saves you on the bad days and therefore helps you generate capital arbitrage, which again helps you generate alpha over long cycles. I think with that, Kamal, I'm pretty much done with the key concepts around this strategy. I'll be happy to take any questions.
Sure, Siddharth.
I can't hear you, Kamal, in case you're saying anything.
Can you hear me now?
Yeah.
Yeah. So I was saying, the presentation has been quite insightful and kind of, the kind of questions that I was seeing in the chat and more which were coming in my mind have more or less been answered. But I would like to, still kind of moderate this realistically from investors' perspective. I can tell you, I ran a poll while you were giving a presentation to understand from the audience that what is their belief. Are they in the current context of their learnings more kind of inclined towards believing that investing into equity is a skill or a science? 75% of people believe either it is a skill or it is more of a skill and less of a science. 25% people believe that kind of it is a less of a skill and more of a science. So I thought I should give you first of all, this context, because audience, I'll tell you, investors mostly, though we say that fund management is more like a science in your approach, right? And maybe in somebody else's approach, it would be science as well as art because it is like a skill. But from investor's perspective, his thought process, I can tell you, is less of a skill. Is less of a science, because investors take decisions more with heart. They are kind of, whenever they decide to invest in equity, the very first aspect that comes to their mind is risk. Though ideally, return should be the very first focus, because ultimately equity is selected for long-term wealth creation. And let me tell you, that is the reason, investors first focus on risk, but ultimately when they decide of cutting a check towards a particular strategy, they are definitely focused towards return, because at the end of the day, return matters a lot. So
Absolutely.
I want to understand, from you, realistically from investors' perspective, if anybody kind of, allocates capital to your PMS and gives it a 3 to 5 year as a minimum horizon, right? How can one expect one's returns in line with the growth in, say, Nifty as an asset class? And if you could give some examples of recent past as how your strategy has performed last 2 quarters or over last 2 years, and how do you expect it to kind of behave likewise over next 3 to 5 years?
Okay, so that's a lot of questions there. Let me take them one by one. I think the first one was around science and skill. The second one was around return expectations, and the third one was around live performance and examples. So the science and skill debate, I'll tell you one thing. if you're an equity investor, you're picking stocks, the skill aspect goes up and the science aspect comes down. What I am trying to tell you is that we are not picking stocks only. For asset allocation, the science aspect goes up and the skill aspects comes down significantly. And to justify this with an example, in the middle of January, north of 18,000 levels, somewhere between Jan 15 to Jan 30th, north of 18,000 levels, we have trimmed our asset allocation from 72% to 40%. Please tell me how many skilled fund managers or investors would be able to do that without getting emotional. In a rising market, when there is strong momentum, possibly upside triggers, we have reduced our allocation from 72% to 40%. And that is the proof that science will override skill for asset allocation. Secondly, about what is your second question? Some recent performance, right? So I'll show you that. Just give me a second. So we've not only been the top performing multi-asset PMS in India, we've also done better than our benchmark itself. And we've been outperforming our benchmark over the last, say, 6 months or 2 quarters, as you said. And we've also outperformed all other multi-asset PMSs. And we are the 14th best PMS in India across all categories: equity, large cap, mid cap, multi-cap, multi-asset. Sub mila ke out of 240 odd PMS schemes, this is 14th. So it's like absolute north top quartile strategy. And now I'm just trying to find that slide which shows you the returns in the recent times. Just give me a second. Yeah, this is the one. So this is showing you based on all the different listed strategies on PMS Bazaar, how we've been the top performing strategy across multiple time periods. So in most of the time periods, we've been either rank 1 or rank 2. And that is proof enough that this strategy is doing well. Our models are working. We are working hard to make sure the models keep improving. And this strategy is more relevant in today's time than ever before. And I think that answers all 3 of your questions: performance, skill, science, and our recent rebalances also. And over the last 3 weeks, that 40% has been increased to 45% as well now. So we've gradually started sizing up our equity allocations because some of our triggers are suggesting to do that.
Sure. So moving on to the next question, again, taking from, I think, how audience is thinking at the moment, we are definitely interested to know more about the strategy, because the strategy is showing evidence of having taken lower risk at right times and higher risk at right times. But if you could throw more numbers to kind of provide evidence of how much was the allocation towards equity in a year like 2020-21, which was kind of one-way rally upwards.
So I'll tell you the evolution of this strategy a little bit. We've gone live since July 21. Before that, we've been prop testing it for, say, 1.5 years. Before that, we've back tested it for 16 years. So there's a period of back test. There's a period of live test. Then there is a period of going live in a PMS vehicle accepting public money. We've only started marketing this strategy more openly since Jan this year. Till then, even after going live under the PMS vehicle, we were still stabilizing the strategy, still making sure that we see some live performance come through, and that's when we reach out to more investors. Now that we are standing 1 year in the game, we see that our performance is coming through. The strategy is relevant today. And now coming to your question about, so in March 2020, which is the COVID crash, we were at 30% odd equity allocations. And that allocation was not made in March 2020. That allocation was made on 7th February 2020. almost 1.5 months before the COVID crash even came to surface. And the reason for moving out of equities so significantly was nothing to do with COVID. It was to do with parameters such as valuation, economy, sentiment, polarization in the markets, etc. Those were the triggers that caused us to reduce our allocation, and COVID coming through was a big plus for us in terms of returns and alpha. After being at 30% till mid of April, around 8,800 odd levels in Nifty, that is when we went full throttle back into equities and inched our allocation from 30% gradually all the way up to 80%. And that 80% allocation we were riding till not till 18,000. I'll be honest about that. It was still 15,900, 16,000 levels, after which we've been gradually trimming. So since we've launched and gone live, all the excess returns that were made between 16 to 18K, we've not participated up to 80% there. We've been more in the 60, 70% zone, gradually coming down.
Right. So, the 8,800 level was achieved somewhere in the third week of March. How would this strategy have behaved between April 2020? So sure. So how would allocation how would allocation towards equity would be between February 7th and kind of April? Because during that period, market was kind of falling every day. So were you increasing equity allocation every day, or you were waiting for it to come to 800 levels?
No. There's no level that we wait for. Again, I'll explain you again. So between Feb 17th till middle of April, when we got the trigger, increase allocation, still then you sit on the 30%, because the model is not telling you to change. Only when the model tells me, increase the allocation to 60%, 80%, that is when we start increasing. So the first trigger of increase was around 8,600 to 800 levels on. So between 7th Feb, when we exited, till we re-entered at 8,800, we were sitting at 30% equity only for all those days.
So you mean to say that this model was kind of not just tracking the macro factors, but also tracking the momentum towards
we have two momentum based indicators as well. I'll take you back to that slide where you can probably see that momentum is, we have two indicators.
So basically, when the strategy got convinced, sure.
Yeah. So we have a multi-asset momentum meter and we have a multi-factor momentum meter. Over and above these two, which are highly short-term and agile in nature, we also have technometer, which captures, technometer uses technical indicators and tries to capture reversals. So after the market has fallen from say 12,000 levels to 7,500 levels, after it breached the 8,600 level is when our technometer is indicating that, technically we sense a reversal, so buy. Momentum meter is saying, based on momentum, we see momentum coming back to equities, buy. Multi-factor momentum is saying equity factors like alpha and momentum are outperforming value, so buy. That is how this really works at the back end.
Are you there, Siddharth? Yeah.
I'm there. You can't see me? I'm very much there. Yeah.
Okay, perfect. Right. So, another question that, subsequently comes to my mind is that now all of us kind of have a holistic view that we are living in an era which is golden period for India as an economy. Over the next 5 years, the the micro picture of India as economy in terms of growth in GDP, there is more or less conviction that there could be a lot of macro, concerns, but at a micro level, the corporate earning growth is going to be kind of relatively robust. And hence, in
Fair
that
enough.
context, identifying some of the right sectors and some of the right stocks and applying skill to equities is a story which long-oriented,
100%.
equity-focused, skilled fund managers are trying to kind of, I would say, sell to various equity investors, right? And I can tell you, when we ran this poll, 75% of people kind of were inclined towards that style of investing. Now, in that context,
Absolutely.
your strategy is more of a science and is trying to take relatively lower risk, is trying to kind of create its own position in the investor's overall portfolio. So from that context, right? So if you put yourself in an HNI investor's shoes, who's already allocated towards some of those long only strategies, how would you kind of answer a question which is kind of more towards trying to expect what is the end goal that he's going to achieve by actually adding this portfolio in his portfolio? If he adds or if he doesn't add, what is how will it change his kind of experience?
Okay. So, firstly, this like long only equity, we also manage long only equity schemes, and we can probably have a separate webinar on that. So, I am nowhere saying that I'm against the concept of long only skill based investing. We do that as well. But this is not an and question. This is not an and or. You have to invest in equity also, but you also have position for this in your portfolio, because on a bad day, when your equity portfolio is down 50% and you need liquidity, you need your capital for whatever reason, this is a strategy that will come handy. So right now, investors, say, who've invested with us in, say, an equity strategy and a multi-asset, when we call them, say, around September, October, and said, start shifting, because over the last 2 years, you made phenomenal returns. Now is the time to protect those returns rather than chase returns. And if we called 100 people and told them to shift, few agreed and few didn't. They are like, nahi, humko to equity hi chahiye. Now, when we are 6 months into this story, all these investors who shifted some capital into a multi-asset approach, they are thanking us. Why? Because their portfolio is down, say, 4-5%, equity portfolio is down 20%, and now they're calling us, market bigad gaya, kya ho gaya, abhi kya hoga? So realistically, let's be honest, when markets collapse, 80% of investors do lose some of their nerves and make emotional mistakes of redeeming in the worst time and investing in the peak of the cycle. We've seen that happen time and again, but I believe our investors are also getting more mature now, and now they're trying to give fresh deployments at the after big corrections and try to maybe stay invested through the peak of the cycles. So every investor who has a 100 rupee portfolio at least deserves 20% allocation to a multi-asset strategy, simply because it will help you weather the storms that you don't know are coming and we don't know are coming. But our model helps you navigate this period with a lot of ease. And at the end of the day, what will remain in your portfolio? Nifty ETF, Bharat Bond, Gilt ETF, Gold Bees. So there is no default risk as such. If you roll it down to 3-year, 5-year, any period of time, there is no risk of capital loss. You can't say the same with a stock that you are buying. You can never say that you will permanently protect capital, even in the best of the companies of India. Management change, external trigger, competitive intensity increasing. There could be so many moving parts. And this is actually for an investor to find out, start at the same time, invest in both strategies, evaluate at a 5-year period, which has been the smoother experience. Has my returns been compromised? Has my journey been better? Because at the end of the day, I want to reach that end destination of high returns, but I also want a smooth journey. And if this strategy can do both, why not?
No, absolutely. It is a well-known, I would say, analytics, which says that 90% more than 90% of returns of a portfolio are determined by asset allocation. Very rarely investors are able to do their own asset allocation in an optimum manner. If a portfolio manager offers asset allocation along with kind of various asset classes, which is kind of not just equity and debt, but things like gold and gilt as well. Obviously, this makes some sense for investors to consider it seriously. So my final set of questions are as follows. I would want to understand from you. You have shown your appraisal of your strategy in terms of its performance if compared to Nifty, if compared to other PMSs, by showing that across the entire PMS universe you kind of stand at 14th number, and your performance has been kind of stellar in over last, say, 2 quarters, as well as since your inception. But besides your performance numbers, are there any other, I would say, performance appraisal methods that you have internally devised for you to kind of understand and attribute that the decisions that you took in terms of selecting various asset classes were right? So you have kind of talked about various mechanisms that you have, which are based, right? How will you assess them, whether they are right or wrong?
So we have our own internal team of programmers. We have a team of quantitative analysts, and we have our in-house quant platform that we've built over the last 3 years. So when we do returns attribution, we attribute the returns of the strategy or the model to each decision it is taking, to each meter that is affecting that decision, and therefore continuously try to evaluate where are we going right, where are we going wrong, what could we still further improve. So our returns attribution tells us that over, say, 6 months, which is a very short time period, or over 1 year, or maybe 10 years, which is a very long time period, the biggest alpha comes simply by avoiding the big falls. That is the source of alpha, which also means usually in a trending up market, you are going to be north of 60-80, between 60 to 80% invested in equities. And that will pair, your returns will pair with equity returns. It is when you avoid the once in 2 year wala big fall, you have more capital to reinvest in equities, and that compounds on its own rate over time. Every time you miss a fall and reinvest, you keep doing that over a 10-20 year cycle, your compounding rate is simply phenomenal. And it's not that I'm saying that our model is 100% accurate. We can pick the bottoms, we can pick the tops. We don't do that. We can't do that. And we don't want to do that. Even if we capture 60 to 70% of any peak to trough move and trough to peak move, we are good enough. And that we do.
Right. So let's, understand from you what your model is conveying at present in terms of allocation to these various asset classes.
Okay, so right now we are 45% equity as a total, including domestic and international. Domestic, we are more bent towards large cap equity, followed by mid cap and 0 to small cap. International, our tilt towards S&P is little higher than our tilt towards NASDAQ. But a combined allocation, you can say 38% odd domestic, 7% odd international. That's my equity piece. 55% is non-equity, which is across corporate bonds, liquid funds, gold, and cash. We are zero weight in gilt since the last 8 months because our monetary meter has moved its regime from a expansionary monetary regime. It is shifted into a contractionary monetary regime. Common sense also tells us that in a contracting interest rate environment, gilt as an asset class is the most hit. So we don't only manage allocation between equity and debt. Within debt also we do duration management, which means long duration, short duration, ultra short duration. So we have had a 15 odd percent weight in liquids, which we consider as ultra short for the last 4 months.
So the success of any business, any idea, any fund management actually, depends very heavily on the founder. Also kind of, that is why any strategy we talk about, we try and understand what is the thought process of the founder. Since you are the key decision maker and the founder, for this PMS, I would want to understand from you, for our audience, are you more inclined towards equity as an asset class or debt as an asset class? What is your take? What is your thought process? What is your area of forte? If I was to kind of peep into your own portfolio in terms of your own personal style of investing, because somewhere you are trying to avoid a lot of biases by trying to make it disciplined, data oriented, but ultimately decisions will be taken by people. And decisions, when people take them, obviously they come from their own learnings, their own experiences, as well as their own beliefs. So hence, it is important for investor to understand before he kind of allocates large sum to this strategy. Hence this question.
So I also actually run an equity strategy. In the equity strategy, my natural bias is again slightly conservative. High quality, specialized businesses, large opportunity size, buy them and keep buying them at economical valuations. So I am more of a quality at reasonable price sort of investor, where I focus a lot on evaluating the DNA of a company, and we have a proprietary way of gauging if the DNA of a company is strong. We mainly look at a durable growth opportunity, noticeable right to win, and ACE governance. If a company meets these three criteria, only then we do any further evaluation on growth, visibility, and valuations. But we do not want to be invested in companies which do not pass our quality filters. So I think there's a big school of thought of investors who are more growth oriented. Some are also momentum focused. Some are quality at any price. We are not quality at any price, neither we are growth at any price. My personal philosophy is bent towards buying the highest quality companies, riding them through the cycles, and keeping on buying them at economical valuations. And economical doesn't mean cheap. We ideally try to avoid companies that are very, very cheap. We look at companies which are fairly valued or economically valued given its growth profile, its cash flow profile, its ROE profile. And the 4-5 tenets we look at is basically an enduring advantage that a company must possess. It must be dominant in the field of its operation. Efficiency must be proven rather than coming into the future. And given all these things are present in a stock, we then look for any sort of specialized players. So if we find specialization, niche plays, that is what we really like in owning, because we believe specialized players can continue to generate high ROEs, can continue to operate at higher margins, can continue to command higher multiples, and can continue to generate superior free cash flows. So we believe specialization is extremely important. You can't be a decent or good player in many things. You rather be an elephant in few things that you do really well.
Sure.
That's my personal take on investing and in the fund I run.
Sure. So you also mentioned that currently your multi-asset dynamic portfolio is 45% towards equity, and it was around 30% during February of 2020. So currently it is 45%, and 2 years ago it was around 30%.
So, in between, it has been 80% also.
Yes. So my two sets of questions: what are the triggers? How will you kind of take it from 45% to 80%? What is it that should be visible in terms of your data points that from currently 45% it goes to 80%? And also in that journey, it may happen that markets have already run up by 15% from these levels, and then you take it to 80%. So how would kind of your strategy actually counter that?
So three things. First is, right now, the macro data points that we are capturing are not suggesting the best picture. So if the macros start improving, that is one potential trigger. If the valuation comes off significantly, that is the second possible trigger. And valuations can come off in two ways: either price correction or time correction. If we go through a price correction, valuations will normalize, our allocations will go up. If the price correction doesn't happen, if the market stays range bound for a very long period of time, which is highly possible, has happened multiple times in history. In that scenario, the valuations will again adjust for a higher earnings growth scenario, which means the multiples that we're looking at, whether price to book, price to earnings, market cap to GDP, etc., or earnings yield, bond yield, they will automatically reflate to a more sane valuation zone, which is when we can again increase. And the other trigger could be supported by either improvement in macros, monetaries, or valuation cycle. If this is supported by a technical or momentum overlay, only then we will increase the allocation significantly. But right now, we are neither seeing signs on macro, nor valuation, nor monetary, nor momentum, nor technicals. So there is no sign to really increase allocations right now.
Sure. So in the overall, asset allocation strategy, do you also keep substantial amount of cash at any point of time?
Liquid and cash is a proxy, so it's the same. We do keep, yeah. If the model indicates,
sure.
We do keep.
What is the percentage of cash at the moment, liquid or cash?
Right now, it's 14% combined between liquid and cash.
Sure. Because it is a multi-asset, dynamic portfolio strategy, it is important to understand how will overall taxation kind of impact be on the returns. Can you please throw some light on this aspect?
So our analysis shows that over a long-term average, when we look at 1 year periods, 3-year CAGRs, 5-year CAGRs, 10-year CAGRs, the net of tax impact is more like 1% on returns, and the peak tax impact has been 1.4%. So in the 1.5% range should be your net of tax return. And if you're compounding at, say, 15% for a long cycle, your net of tax could be more in the range of 13.5% to 14%. And we've devised it to be tax efficient given that 50% component, which is extremely long-term in nature and meets the LTCG criteria. 35% could be LTCG or STCG, and 15% is definitely STCG. So I think on an overall portfolio, the tax is pretty well shielded, given that if we are making superior returns on debt, the quantum of the returns is so small that your net of tax impact will never be too high from a debt investment. Your net of tax will always be impacted, mainly driven by your equity performance.
Sure. Because, your portfolio is a multi-asset dynamic strategy, not just your skill set towards equity kind of will determine the ultimate returns, but your skill set and your overall, team's capability towards debt market will also play a significant role. Hence, this last question is on this aspect. Over last 1 year, we have seen suddenly interest rates started to go up, and the long duration bond funds obviously, have given negative returns. So
we had zero allocation to long duration bonds, not even 1%, zero.
Even at the moment?
Yeah, zero. It's zero.
And it's zero since which month? If you could kind of give some light on that.
September it was 3%. October it was zero. So since October it's been zero.
Sure.
So again, it's not my skill or my team's skill to read about gilt funds and then take a decision. It is our skill to have understanding of the asset class, translate that understanding into our models, and basically get the answer from the model. So possessing that skill at our level is important, but using that skill to make decisions is counterproductive for this particular strategy.
Right. Thank you so much, Siddharth. I think, it's quite insightful, and this is truly a unique process-based, discipline-based, unbiased, quant, oriented dynamic portfolio management service that you have kind of conceptualized, which in my opinion has a lot of takers, especially in the HNI and ultra HNI category of investors. And I wish you all the very best.